Hi, Kristi Sullivan here with Sullivan Financial Planning. This video is a short accompanying video to my blog about zombie firms. If you'll remember from the reading, zombie firms are those that are being probably artificially propped up or kept on life support by low interest rates. So these are companies that cannot even pay their own interest on their own debt without either borrowing more or liquidating assets. In other words, they're firms that are not very productive and not profitable, but they still exist. So you can think of recent examples like Sears or Toys R Us in the zombie firm category. A lot of that had to do with being bought out by private equity, taking on crushing debt, and then not being able to meet their debt obligations because of the private equity buyout. That's a whole other video that maybe I'll do another time. But what I wanted to address today is what is the importance of zombie firms and should we be worried about them? Zombie firms right now make up 14% of the S&P 500. And that's compared to 2% in the 1980s. So it's a pretty big chunk of our economy. And actually globally of developed markets, zombie companies make up 12% of publicly traded companies. So it's a lot. What will happen is eventually a recession will come. I don't know when, so don't pretend like this is some kind of crystal ball. But when the recession comes, that will, and low interest rates are not enough, cheap borrowing is not enough to keep these companies alive, they have the potential for going under, creating unemployment and creating a lot of nervousness in the market. So think about it. If your S&P 500 index investment, which a lot of you have, if 14% of their businesses go bankrupt, will you have the intestinal fortitude to hang on to your basket of S&P 500 investments through the recession? Zombie firms are a drag on the economy. They keep resources, employees, productivity, capital going to companies that really maybe don't deserve them and should be weeded out anyway. That's what a recession serves to do very often, is weed out companies that are not very profitable or not doing very well anyway, but are just kind of languishing on in the case of a strong economy. So zombie firms, what are you going to do about them? You could look for them. I think there's several ways to search in Google what are zombie firms. Some well-known names are zombie firms, actually, Uber and Lyft and others that they don't actually show any profit, but they are publicly traded companies and their stock goes up and down based on news and that sort of thing. But do think about, if you're looking at individual stocks, weeding out the zombie companies. And if you are a broad mutual fund investor, which is what I do, remember that even if 14% of the companies that you hold, or hopefully it's less than that, maybe it's 8%, go out of business in the case of a recession, you've got many other companies in your diversified portfolio that you're hanging on to. So I don't think there's any reason to panic about zombie companies, but I do think it's an interesting thing to teach yourself about. Thanks very much for listening and watching.